Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Sorry that we're late. We are going to do a simultaneous Facebook Live and podcast. So if you're on the podcast, welcome to the Get Real Podcast, and everybody joining us on Facebook, welcome. Anyway, they changed all of my settings, and so it took me a little while to get on here, and Heather's going to be on in just a second. So there she is.
Sorry.
Wow, that was anyway. We thought we had that all handled, so apologize. So I already welcomed everybody and our awesome podcast guests and everyone else, Heather. So let's get started. You're muted for whatever reason.
I want to pull it up so I have it so I can get, and it always starts talking.
Okay,
So give me 1 second.
Yes, what's up? We've got some people joining us here. So anyway, sorry we're late. Hopefully, if you were on here waiting for us, which I know there were several people who were, because we were getting texts like, "Where are you guys?" Anyway, so apologize for that.
Hey, Jared, what's up? It's Jared. So
Heather, let's start this off, and by the way, we just got done recording another podcast.
Oh my gosh, it was so good. It was so good.
It is going to be, when it drops, you guys need to make sure that you listen to it. It's about IRAs, but so much more than that. Oh my gosh, it was fantastic. Anyway.
Yeah, it should drop Monday. So you guys, it will dovetail great into what we wanted to talk about live in here today. We like to do it live because we want to know what questions you have. We want to be able to answer your questions. So please chime in the comments. But we wanted to talk a little bit about what I've been seeing online and like social media a lot. And then what I've also been hearing from clients and what we're kind of seeing with the market shifting a little bit with rates increasing, and what does that mean? And I think a lot of clients don't know what to do with that information. So understanding that rates are going to go up this year is, I think, a mindset thing more than anything else, being prepared for that. So making sure that you have your expectations, because what I anticipate, a lot of novice investors will just stop and wait for the market to shift and prices to drop, because they're told, oh, well, the market's got to come down. And so they just sit and wait. And I definitely am still buying as fast as I can get my money and have my reserves, right?
Yeah, I mean, it's so the question isn't really, do I stay in the stock market? Do I because it's high too? Do I buy real estate? Should I just chuck it all in gold? None of those things are really. I don't think that's really the appropriate question. The appropriate question is like, well, what are we trying to accomplish when we're taking all of these very emotional things and making decisions with them? Like what is it that we're trying to accomplish? Are we still trying to get the highest return that we can get? Are we still investing long term, or have we completely just lost it because somebody on Facebook said something, or somebody on the news, God forbid you're listening to that, said something, right? Anyway, I mean, because I've seen them too, Heather, and there's more than 3 or 4 different posts that are going around. One of them is that 20% of the homes are being bought by hedge funds, right? There's other ones out there that are the market's at the top of and what it's going to crash again, right? There's all of these things out there, and then cash flow is not as good as it was in 2014 either.
Yeah.
So what do you do?
Yeah, I think one thing that we've been thinking a lot about is watching and hedging against inflation, right? We talked about that. making sure that you're ready for the wave that's coming. And if interest rates are going up, you just have to realign your expectations on cash flow and what cash flow is going to look like. Because here's the thing, rents are going nowhere but up. And they're going up so fast that we're having a hard, because they're 12-month leases, right? So you can get a property today and expect that it's going to be going up. The rents are going to be going up, which means more cash flow. But in the here and now, it may not happen that fast, right? So resetting expectations with that, resetting expectations of what your return on investment minimums should be. We've had a lot of our rehab properties coming in with lower ROI, and I talk to our sellers about it, and they say, Heather, I can't buy houses for the same price as I could before.
Nope.
So a lot of people assume that when our prices on rehab properties are going up, that just means our sellers are trying to take advantage of the market. And of course, to some degree, they want to sell for the max dollar that they can. However, they are telling me that their bottom line is about the same. What their profit numbers are about the same, even though prices are up. Costs of materials are up, and prices that they can buy from wholesalers are up. So that they can't, if we have lower prices on rehab properties, they don't make any money, which means we won't have rehab properties.
Yeah.
So,
there's the same things going on with new construction, right? So new construction is getting more and more expensive. Every single piece of the construction is getting more expensive. And I don't think that's going to come down anytime soon. Inflation is here, folks. It is, it's double digits. I don't care what they're telling you on the TV. It's double digits. It's at least 10, probably more than that. And it's going to be here for a little while. So buying assets that produce cash, that are hard assets, that, don't melt away just because, some CEO did something wrong, or,
government even.
Yeah, whatever happens, right? Having something that's actually physically present, that actually is producing cash, is important. And, real estate, even if the market goes down like it did before, this won't be the first time if it does go down. I don't think it's going down this year anyway, but even if it does go down, this isn't the first time. And last time, when it got cut down by about 40% in a lot of markets, the people who owned rental properties, they just continued to make money.
Yeah.
Because they were still paying down their mortgage, they were still getting the tax incentives, and they were still cash flowing, and the rents just kept going up.
Yes. In 2008, that's something that people don't often think about, is that rents increased. And so there was more demand for rentals, not less. And so rents are going up while prices are down, but you just wait for a hot minute, right? And you have 20% equity in a house right now. That's all you can buy on an investment loan is 20% down. So if you have a 20% down property and you have prices dip 20%, you still are okay. If they dip 40%, you got to wait for a minute for them to come back up. So it's the fear that I see kind of ruling decisions, right? Instead of just looking at the numbers, right? Just still looking at the numbers.
And looking at all the numbers, I think we get myopic a little bit in our approach to looking at numbers. If you actually take a look at a portfolio long term, cash flow is really, really important. It's the number one rule. The reason that we teach that it's number one rule is so that you don't get in trouble if the market, regardless of whether the market goes up or down. So you don't get in trouble with your reserves, right? So if your property is cash flowing, it should be able to cover itself, right? And then you should still make some money after the fact. But then after those, you have three other very powerful returns that are all stacking on top of each other. And I think that people, when they're looking at pro formas, tend to get very, very myopic. Okay. And what do I mean by that? Let's say our, over the past year, we've seen our new construction numbers drop from probably a 14% cash on cash return to somewhere between 9 and 11% cash on cash return.
Mm-hmm.
And people freak out about that, right? So you got to understand that those numbers are still dramatically higher than most people are selling out there, right? So those are equivalent of somewhere between a 6.5 and a 7% cap rate.
Mm-hmm.
Most people, including the hedge funds who are heavily buying, are buying between 5 and 6% cap rate. They're buying a full point underneath, right? And in some cases, 2 points underneath that. And that's because they're looking at the long term and they're looking at all of the returns as well. And it makes sense over time, right? Now, we go out and fight to get you guys better deals than that. Cash flow is better than that. But you have to look at the whole thing. You have to look at the entirety of the returns, because the other returns are equally as real, right?
Yeah, good point. I think one thing that I learned a lot from this podcast we just recorded that you guys will see Monday is that with these interest rate increases, historically what's happened with those is stock market corrections, and stock market will drop according to the historical pattern, right? So preparing for that, what are you going to do to help offset some of that risk? And that's why we talked to John Gillane, who's with Mountain West IRA, to talk about utilizing your IRA, maybe looking at your statement for a minute and making sure how it's actually performing versus what the news is saying it should be doing, and making sure that you're ready for if the stock market has a correction or a drop. So definitely another thing to watch out for. So Jared is saying, after the jobs data today, I'm sure the Fed will be even more aggressive. And also with increasing home values, are you expecting insurance to dramatically increase? Not really.
No, not ours anyway. And if you go back, if you're not on our podcast, if you haven't subscribed to the podcast, you should. And if you just go to your podcast app and type in Ron Phillips, it'll come up. It's called the Get Real Podcast. And we did probably several months ago now, right, Heather? We had on our insurance
Patrick Hodges,
owner of the insurance company. Our master insurance policy, our group, all of us who collectively make up our portion of that master insurance policy, we have the lowest loss runs of all of his of all the insurance that they have.
Yeah, I think he said that after we finished recording, because I think he didn't know whether to say that on the air or not, but that it was, he said that everybody else had rate increases, but we did not.
Yeah, I think ours went down very slightly. Ours went down. So no, I don't think that's going to happen. Now, obviously, with the cost of construction going up, we're already getting replacement cost policies. So, I don't think that that's really going to go up tons. Insurance, if you raise it just a little bit, it's such a minute amount that your monthly goes up that I don't think it'll really have a dramatic difference. So no.
Yeah. And you can, Jared, you can choose to increase the replacement cost, over $80 a square foot if you want to, just because construction costs are up. I'm keeping mine at $80 a square foot personally. So it's up to you, but yeah, that's definitely something that could affect it.
Yeah, and if anybody else has questions, feel free to put them in there. Jared is very familiar with how this works, so he's all over, he's all over it. Yes. But yeah, I'm pretty bullish on real estate. Not necessarily that real estate's going to continue to appreciate the way that it has been. I don't think that's going to happen. I think we'll see appreciation this year, but I think it'll slow. And I thought it was going to slow before they said that the rate increases were going to happen, and rate increases are going to slow it a little bit more. I think we have to be forward looking too, as we're looking at our cash on cash returns, right? That the rents are going to continue to climb. And, I think that things are going to slow down. I don't see it falling apart. Yeah. Because, people have been bidding up prices. If you actually think about this reverse psychology just a little bit, right? Let's say prices flatline. Well, people have been bidding in a lot of the markets above retail price.
Yeah.
So here in Charleston, for instance, people will bid $50,000 to $75,000 above so that they can get the house because there aren't enough houses.
Yes.
Okay? And that's happening in a lot of different markets. So $50,000 in a payment, right? When you compare it to the interest rate, it's basically people are already comfortable paying a quarter to a half to 3/4 of a point in some markets above where they are right now. They're just paying it in the price instead of paying it in the rate. So if the rates go up, prices may flatline, but I don't think they're going to collapse because we still have a supply demand problem, right? Now, what does that mean? That also means that if things slow down a little bit, there's going to be less rental properties. We already have inflation going crazy, and rents typically track with inflation. So rents are going to continue to climb. And so the properties that I'm buying now, that Heather is buying now, those properties are going to continue to creep up with the cash on cash returns. And I think for at least the next couple of years, they're also going to continue to appreciate. And then of course you've always got people paying your interest rate, your principal down, and you've also got your tax benefits. So I don't really think there's going to be a whole lot that's going to happen. We will lose probably another 2 to 3 points, from the peak that we had on new construction on cash return. But I think that's going to be made up in other places, right? In rent increases over the next. And I've just watched this happen because we sold we sold some properties a year ago. Heather, what was it that happened with the rents? I want to say they went up like $150.
Oh, you're talking about the townhouse. Yes, it's almost $200. Well, so we've waited to have them built, and they said, well, we're going to have to raise prices. Our costs are up, which everyone gets, right? That's nothing new. And he said, but rents are up. And so we ran the numbers, and it actually performs almost exactly what it was before because rents went up with the price going up. So same difference. Oh, and rates went up. So they actually went up. It was going to be better performance, but then rates went up. So it was about the same.
Yeah.
Worth waiting.
Great question. How is inflation? It is going to impact people. There's no question about it, right? It's going to impact, no, I'm not going to go on a government rant. I'm not going to do it.
Stick to the question, Ron.
This is basically a tax, and it is a regressive tax. So it is going to hurt the lower income people the most. Lower income and middle class people are going to get hit the most because all of the things that they spend money on are going to be more expensive. Now, that said, I can tell you as an employer, and I can tell you because I talk to a lot of other employers, our costs are also going up, right? So the cost of all of our human capital is going up. And so everything is going up. So I do think that is going to hit the lower and lower middle class harder. So C-class properties, it's going to hit them probably a little bit harder. There's going to be a little bit more churn. But if you're screening your tenants properly, and they have, if it's 2 or if it's 3 times, I don't know exactly what they're doing right now, but I think on all of our properties we do 3 times what the rent is. That's what you have to make. If you're screening them properly based on their income, we should be okay, right? The good news is that because there's a shortage of houses, you have more people that you can screen. And, that means you get to be kind of choosy about who you put in your properties, which is kind of nice. It's unfortunate that it's going to hurt some people. Some people are they're going to get hurt. There's no way around it. I don't think it's going to necessarily hurt us because there's going to be an abundance of people for us to screen, and we can choose the ones who can, afford the properties.
I have a tenant not paying rent still in one of my houses, the same tenant that I've talked about. And they basically will just need to go to a more affordable place. right now they're paying probably toward the high end of rent in that market. And they've had some job loss and some tumultuous times like a lot of people have in the country. And so essentially I'm going to have to evict that tenant and tell them, you need to go live somewhere that's more affordable for you and in part of town that's more affordable for you, and owning on the higher end of rent in the area.
Yep.
So
I mean, just historically, guys, if we go back to every time that the market corrects, number one, I believe that the stock market is, it's had a really good run. So has the real estate market. The difference is, I don't think there's such a supply-demand shortage.
Yes.
I don't.
It's a hard asset.
There's just an inflated thing going on in the stock market. I'm not a fan of the stock market, so I'm not even going to pretend that I am. But man, it's been on a tear for a long, long time, and it's going to correct when they start raising rates. So, and they're going to raise rates. So all of that is going to happen.
Yep. And one thing that maybe we didn't say, because this was something that was helpful for me in understanding, is they have to raise interest rates because inflation is so high. So they have to get it under control. And really, they should be increasing it more than what they're saying they're going to increase it in order to get it under control. So
I'd like to just state for the record that when I started doing this, right, in 2005 when I started selling properties to people. I started in real estate in 2000. But the interest rates were like 6.5% to 7% when I started. And, the rates of return were, 7.5% cash on cash, 7.5% to 8% cash on cash return. And the people who bought those properties, matter of fact, we're just talking to the podcast is going to be great. You guys are going to love it. But my buddy, John Gallane, bought a house from me.
Yeah.
In 2007, like right before the crash, like the exact worst time you could possibly buy a property. If you were going to choose to buy a property, that would have been the exact wrong time to buy a property. And he paid retail for it. And the cash on cash return, it was sub 10. I don't know where, but somewhere in there. And he just said on the podcast that he's held that property. He just sold it. What did he say last year? Or something like that? I can't remember exactly. Yeah. Whenever he sold it, he said that he made about a 30% on it.
Yeah.
Annualized return, which is almost unbelievable because he rode the market down all the way back up. And the whole time someone was paying off his property, he got tax benefits. And in addition to that,
depreciation.
He cash flowed. And his rents went up the entire time. Right. So his cash on cash return continued to go up, and then he sold for a really decent profit. And, here we have in our lifetimes, the worst possible collapse of the real estate market. And that's what happened.
Yeah.
That's what happened. So all you really need is a couple of things. You need reserves so that if something happens, you don't have to dip into your money to be able to fix it, right? The property should be able to take care of itself, and you need to have reserves for every single property that you buy. You need to have reserves. Okay, if you have reserves and you're not over leveraged,
that's what I was going to say. Don't be over leveraged.
And you've bought the property right to begin with, which means it cash flows.
Mm-hmm.
It
shouldn't be a dog property that's going to totally blow up with repairs, right? I mean, but you have your reserves just in case, right? So that was one thing that I wanted to reiterate about the insurance question Jared said, is he said that your properties are across the country, so they're diversified. And the reason why our rates haven't gone up, is that we're diversified in location and that we just really haven't had a lot of claims because we sell newer or fully renovated as much as possible properties. So there's just not as many incidences of insurance claims. So that is a testament to overall the type of properties that our clients own, right? So that's hedging against the issue of insurance rates going up. So same thing for preparing for any kind of tumultuousness in the market.
Yeah. So what do we consider over leverage? I think right now we have rules in place, forced upon us by the powers that be that keep us from being over leveraged. So the 20% and 25% down for duplex and fourplex properties, that's perfect. Back in the day, there were no money down properties, right? We had no money down properties, stated income, no money down loans. And, as much as we tried to talk people out of it, they were having negative cash flow. People were buying crazy, just psychotic stuff back in the day. And, I would try to talk people into buying cash flow to offset, and it would just win in one ear and out the other ear. The fundamentals that you guys have been taught how to buy properties, with cash flow being the number one rule, and it's an unbreakable rule, will keep you from having those problems, right? 20-25% down, that's solid. If you could find some kind of a crazy loan, because there are some out there that allow you to do 10% down. I just don't think that's smart. A, you're going to have to pay mortgage insurance, which affects your cash flow, and B, you're putting less money down, which means you're going to have a higher payment, which also affects your cash flow. So yes, you can buy more properties, but they're not going to be covering themselves the same way. They're not going to be producing as much cash flow, and I think that's a train wreck waiting to happen. And I actually witnessed it back in the day. So not smart.
I would add to that, though, this Florida product that we're doing, I am doing as a second home loan, the 10% down, because there's an equity spread that will allow me to get PMI off, right? There will be the equity in there. That's the pain point. So
yeah,
that is probably the only exception I've seen, because I agree to not have crazy.
Yeah, that's an unconventional mortgage with an unconventional product.
Yes.
So just from buying a rental property perspective, 20 to 25% down, good to go.
Yep, agreed. Any other questions, you guys?
Yeah, this seems to be an interesting topic online, so we wanted to make sure that we were covering this for you guys.
Ron, maybe you could cover a little bit why hedge funds are buying property. Why? Because I've seen that be a concern. Like, hedge funds are driving up our prices.
So they're buying about 20% of the inventory, almost 20% of the inventory, and I think that will probably continue to climb. And the reason is because they see everything that we're seeing, right? That these are hard assets. They're backed by an actual physical asset. That asset produces income, and it gives all of these other awesome benefits that the other assets that they've notoriously in the past invested in don't. And you throw onto that, you throw on the fact that we're in incredibly inflationary times. They want something that's going to track with inflation. And unfortunately, the stock market doesn't do that. And they've figured out what a lot of us have been preaching for a long, long time. Is it unfortunate that they're coming in and buying up a ton of inventory? Sure, but has it really made a humongous difference in any of the markets? You could make an argument that the some of the supply and demand in certain areas is made up because they're taking 20% off the market. But then I would make the counter argument that, well, we still don't have enough properties for people to rent.
Yeah.
So they're taking 20% off and they're renting them to people, and they still have rental demand. So we still have a supply and demand problem, both in the rental market and in the home ownership market. And so I don't, long term, could it have an effect? I guess it could. But right now, no, because we haven't built enough homes for the last decade. And Heather, goodness, I was preaching this back in presentations in 2014, 15, and 16, that we're not building enough houses. We have a shortage of houses. And you guys have to understand that back in 2007, right before the crash, 2006 and 2007, there were certain areas of the country that were overbuilding. Not the whole country. Certain areas of the country were overbuilding, right? And the rest of the country took it in the shorts the same way that those specific areas did.
Mm-hmm.
And they couldn't build any houses either. And it wasn't like there wasn't demand in those areas. And then we continued to not build houses for like 5 to 6 years.
Yeah.
And then when we started building the houses back, we did it at such a low rate that we didn't catch up, and B, we still didn't even meet the needs on the years that we were building them. And we've done that now for over a decade.
Yeah.
So it's no wonder that we don't have enough houses.
Shocker. Yeah. And I mean, the slide that you would show, and you would take out those few markets that were crazy high and how the dramatic drop in pricing in that area. If we took out certain pockets of Florida and California, the average across the country wasn't that bad. It was
really
just
wasn't.
that it was tanked by a few outliers.
Yeah.
So,
it was under what we were just saying, what was not over leveraged, right?
Mm-hmm.
So it didn't reach the level of the leverage that
Yes.
all of you are buying with.
Yes.
The only areas that did were the ones that didn't cash flow anyway. And you shouldn't have been buying there, right? Those are the people who lost everything. They're the ones who bought speculative properties. And I see people doing that right now in the Airbnb market. They're buying way overpriced properties because the numbers currently work for Airbnb.
Mm-hmm.
And I think that's a mistake. I may be wrong.
Yeah.
But I think that's a mistake.
A couple of takeaways, I would say, Jared, and we can do a podcast on it like you're suggesting, but about the housing collapse. One takeaway I had, because I was working with Ron at the time as a newbie for sure, but is I couldn't buy. I had money and I could not buy. That it was so hard to qualify for financing. And then they took the number of conventional loans per person down to 4, right, Ron? Isn't it 4?
Yep.
And so if you had 4 loans,
not like 4, and then you got like hit and you could go up from there, like 4 hard stop.
Yep, you had to pay cash. That was it. So being smart and strategic with loan positions, making sure that, for myself, I have my husband, myself, my husband on our rental properties on the mortgages. It's not both of us because it uses up a mortgage for each of us. So I only have, I think, 2 or 3 mortgages in my name, even though we're up to 13 doors. So that is one way to help. And you can get a loan right now that you can wrap a bunch of properties into one commercial loan and then free up those conventional mortgage spots too. So
yeah, I think one of the other really big things that I learned that I think that gets glossed over, quite a bit is that both the stock market and the real estate market, they both crashed, right? The stock market crashed within months, less than a year. Mm-hmm. It hit bottom. Like it was, it was at the bottom. The real estate market took 5 years to hit the bottom. It just kept going down. I mean, it was remarkable, actually. Now, I think that a lot of that was exacerbated by the government and what they did. But because, again, if you can't get loans, nobody's going to buy the properties. Nobody buys the properties, yada, yada, right? So that all got exacerbated by the government. But those 5 years, everybody loves to call the bottom. Everybody likes to buy at the bottom. But during those 5 years, if you actually waited for the bottom, you lost so much money.
Yes.
Because there were great deals every single one of those years as the properties continued to lose value. So we started buying in late 2009, early 2010, and the market kept falling. And I wish I had every one of those houses I bought in 2010. So waiting for the bottom, trying to time the market, all of that is a fool's errand. The most important thing to do is to buy for long term. Mm-hmm. Make sure your property's cash flow. Make sure you're not over leveraged, right? And then just let the 4 returns work. Just let them work. The big difference between the stock market, which you actually do kind of have to time, right? Because if you have money, the difference between real estate and the stock market, really quick, is this. Stock market's at a high right now. When it falls, there isn't any other return you get that's going to compensate for the fact that you just lost 50%. You just lost it. It's gone. Now, if you sell and pull your money out, you've locked in the losses. Okay. But if you keep your money in the stock market, you still have to go up 100% to break even.
Mm-hmm.
And that takes a long time, people. Generally, like 7 to 10 years it takes for that to happen.
Mm-hmm.
Okay. You've lost all that time. Real estate, it's different. So it took us 5 years to hit the bottom. During that 5 years, the difference is you were having a cash on cash return, you had somebody paying off your mortgage, and you still got tax benefits. Those three returns continue to work during all 5 years.
Yes.
And during the next 5 years that it took for the real estate market to come back up to even. So both markets took a long time to recover. But only one of those markets gave you ridiculous returns during that time.
And way faster than waiting 100% just to break even. 100% rate of return.
Yep. So, I mean, if you could call the markets, if you could time the markets, and you could pull your money out of the stock market at the top and then put it safely into real estate, that would be a win.
Yeah.
Right? Because you're going to get paid the whole time, even if the real estate market goes down. So anyway, I'll get off my soapbox now.
Preach. That was so good. So hedge funds, Michelle's asking, what would stop them from buying? Like, what would stop them from continuing to buy, I should say? And when do they sell? How would that affect the market? I don't know.
Yeah, I don't know. It remains to be seen. I mean, could they affect the market if they own 20% of the market and they all decide together to put them all on the market at the same time? Sure, they could.
Yeah, I just don't know why they would want to flip the market.
You know, so, I mean, if you think about it, you have to think about it from both angles, right? You have to think about it from a rental angle. You have to think about it from a retail sale angle. So let's say they dumped them on the market right now and our inventory increased by the 20% that they own. They couldn't do that because they have tenants in them right now. But let's just say they were all vacant and they decided to just put them all on the market all at the same time. Well, when they take those all off the market, yeah, I guess it could have an effect on prices, but if we're all smart, we'll buy them and rent them to the people that they just kicked out of their houses. Because you can't displace 20% of the market. They don't have anywhere to go.
Yeah.
You know, so those people generally rent for one of two reasons. Either they like to rent and they don't want to own, or they can't own. One of the two reasons. And in either case, they're not going to go buy the retail houses that they're putting on the market, which means they're going to rent from someone. So I don't know. I just don't see it being as disruptive a thing as everyone else does. The one negative that I do see of hedge funds controlling so much real estate is that they will control pricing of the rental properties. You know, which you know, that could be a problem.
Yeah.
In a lot of different scenarios, it could be a problem. But the good news is that they're generally speaking pretty self-absorbed. So they like to make money.
Yeah.
So,
I mean, and flooding the market, giving that many rentals on the market at the same time, it's harder to get top dollar for your properties. So that wouldn't make much sense for them to do that either.
Yeah. And I've seen their models, guys. Somebody is saying, in Sacramento, they still haven't sold. I know they're really not selling very many. Their only thing that I can see that they're doing is they're cleaning their inventory. They're selling the dogs and they're keeping all the rest of them. And then they're reloading. I've seen their business models. Their business model is not a short-term pump. It's just, they're not just going to like dump them onto the market. This is a long-term play for them. And the model only works the way that they're doing it if there's appreciation. It literally will not work if there's not appreciation.
Yeah,
they're making a huge long-term bet that real estate is going to continue to go up, which it has proven to do for decades and decades and decades and decades and decades. right? So I don't think they're going to do that. Yeah, I do have kind of an issue with, big corporations controlling, housing just from a,
free market type of.
just from a free market perspective, having that much control over housing. I mean, they already control food, right? So that part of it is kind of, icky to me, but as investors, I just don't see the disruption. I don't.
So we have a good question from Jimmy. He says, in order to free up my 10 mortgages, would a second mortgage on a paid off property or commercial loan be better? I mean, with inflation, yeah, go ahead.
That's a really solid, individualized question that we should answer and get on a call and answer with you. Because the right answer is it depends. And, rather than get into all of your finances right here on Facebook Live and on a podcast, we should probably get on a call. But there's definitely a way to free up capital in some way, for sure. Yeah. All right, everybody.
With inflation, mortgages are nice to have. That's all I was going to say.
Yeah, for sure. I mean, locking in 30-year money right now, in my opinion, is a no-brainer.
Yeah.
No-brainer. That's another thing, just really quick. Everybody gets all bent out of shape because the rates go up from 3.75 to 4.25, and from 4.25 to 4.5. We are so spoiled. Do you have any idea how low 4.5 is? It was 2 years ago. I locked in what I thought was the lowest rate possible on an apartment complex at 4.59%, and I thought I hit the lottery. So it's so fast we lose, we completely lose sight of what's actually happening and what's happened. Rates are so freaking low right now. Mm-hmm. Would you consider using a HELOC? Yes, I would consider using HELOC. As a matter of fact, I do use HELOCs. So,
she's saying, would you consider that over leveraging though?
No, not necessarily, because you could put a mortgage on that property and cash flow that property, or if it's one you're living in, you could make the payment on it. I use, so if I have a paid off house and I put a HELOC on it, I use that HELOC as cash, because I paid the house off with cash. I just have access to it, in other words. So
yeah, and yes. Michelle, I would add that you still have equity in the home you have that equity line on. You still have equity in that house. So it's really not dipping into too much equity in your property. So while you're 100% leveraging the replacement property, you have income coming in from it. So it's really that you have equity in that initial house you're taking HELOC out on as well. So good questions. I'm digging this. We should do this more often.
Great questions. And really the only reason we don't do this more often is because y'all don't tell us what you want to hear. Yeah. So once you just get on the group, start typing in there what y'all want to hear, and we'll jump on here and we'll do lives with you guys. It'll be great. And we really appreciate it. We've been on for a little while, so we're going to jump off. And for everybody who's been listening on the podcast, we say something, guys, those of you in the Facebook group, we say something every single week on the podcast. And I think it's apropos for everyone, no matter what you're trying to accomplish. And that is get out there and make something happen. So this week, whatever it is that you think you should be doing, just actually get out there and make it happen. All right.
Amen.
Until next time, people.
Thank you.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.